Futures on commodities. Brad Williams, Frugal Finance. Let's talk about futures on commodities. We haven't talked too much yet about futures other than an index here or there. So how about futures on commodities? What's this all about? Well, let me explain. Futures on commodities are contracts where people agree to buy or sell a certain amount of commodity like gold or silver at a set price on a future date. Remember that. What are we doing? People agree to buy or sell a certain amount of commodity like gold or silver at a set price on a future date. In other words, I want to sell you 1,000,000 pounds of silver a year from now. We can either use a forward contract, which is sort of a private deal, or we can just play around with the futures contract. These contracts can be influenced by factors like storage costs and income earned from holding the commodity. When gold producers use strategies to protect themselves from price changes called hedging, they might need to borrow gold from banks. Banks pay interest, called the gold lease rate, to the owners of the gold, like central banks. This interest, along with storage costs, could add income to the holder of gold or silver. In a simple formula, F of O is equal to S of O times EXP R of T. In a simple formula, F of O is equal to S times EXP R of T. When there are no storage costs or income, it shows the price of the futures contract. But if there are storage costs, it can be seen as negative income. A modified formula, F of O is equal to S of O plus U times EXP R of T, accounts for storage costs. For example, if you have a 1-year futures contract for an asset that doesn't provide income, costs $2 to store, and the spot price is $4.50, the theoretical futures price would be $484.63. If the actual futures price is higher than $484.63, someone can buy the asset and sell futures to make a profit. If it's lower, someone who owns the asset could sell it and buy futures to earn more. We've gone over this. We'll just leave it at that. If storage costs are related to the commodity price, they can be considered as negative income, and in this case, a modified formula. Income and storage costs, hedging strategies of gold producers, leads to a requirement on the part of investment banks to borrow gold. Gold owners, such as central banks, charge interest in the form of what is known as the gold lease rate when they lend gold. The same is true of silver. Gold and silver can therefore provide income to the holder, to the central bank. They also have storage costs. This shows that the absence of storage costs are generally treated as negative income. So we have this F of O is equal to S plus U, R of T. Imagine you're eyeing a 1-year futures contract for an investment that doesn't generate any income. Here's the catch. It comes with a storage cost of $2 per unit. Assume that the spot price is $4.50 per unit. And would we assume up here $4.50 per unit? The risk-free rate is 7% per annum for all maturities. This corresponds to R is equal to 7, S equals 450, T is equal to I, U equals 2 times EXP equals $1.85. F of O, S of O, U, EXP, R of T. The theoretical futures price given by F of O 4 plus 1865 EXP is 484.63. If the current futures price surpasses 484.63, a smart arbitrager will snap up the asset and sell short 1-year futures contracts, ensuring a tidy profit. On the other hand, if the future price drops below 484.63, investors who already hold the asset can boost their return by selling it off and look at futures contracts. If the storage costs net of income incurred at any time are proportional to the price of the commodity, it can be treated as a negative yield. In this case, F of O, where U denotes the storage cost per annum. So bottom line, like every other forward relating situation where we're trying to figure out the price, the pattern is pretty much the same. The variables change a little bit, but the calculations are pretty straightforward. We're kind of seeing a pattern here where we're dealing with continuous compounding. and all we're doing is finding the forward price or the future price. Brad Williams, Frugal Finance. Thanks for watching.